Well, yeah, the weather was bad this year, but even just normal weather, winter is normally, or spring is normally a weak time for the housing market. On a seasonally adjusted basis, it's going up 0.8% nationally. But that's good. I mean, that would be something like 10% a year. But that's a little bit less. So you're right, it is slowing gradually. It's weakening. And I worry that it's going to weaken more because I think investors are in the market when they know that there's momentum in home prices, more than in stock prices. And they were observing these big price increases, and it's enticing. Now, it may not last, and these investors may be gone. I think stocks are undeniably expensive, but I'm still in the market because I think that even at the present CAPE, this is my cyclically adjusted price-earnings ratio, even at the present level of around 25, historically they still do all right, even at that level.
Expects to raise interest rates.
I don't think the Fed changed its position. In fact, it tried to say very explicitly in its statement, we believe that the forward guidance or the expectations have not changed as far as we're concerned. So it's a little bit puzzling that the market would react the way it did. I think what you need to do is pay attention to what she said after her reference to the 6 months, which was that it was going to be data dependent. It was going to depend on the outlook for inflation and the improvements in the labor market, and that those were the things that were going to matter, that would dictate when we consider raising rates. I have, my dot is at 3% at the end of 2016. Okay.
Interesting.
2016, not 15.
16. And where are you in 15?
2 something.
2 something.
I can't
So more
exactly.
than. So that
Probably
means you.
more, I'm more than the median.
So.
Well, the 2 types of mistake they could do is one to start too soon and hike too much, and that could lead actually to market consequences like we saw last year when there was a surprise from the Fed tapering. Another one could occur right now. But the other mistake is that they could actually start too late and ease and normalize very slowly, not in terms of risk of goods inflation, but of asset inflation. Well, U.S. economic growth is going to recover, even if I'm below consensus. I think it's going to be only 2.6% this year. The Fed is going to exit only slowly. I think that single-digit returns on U.S. equity this year are warranted, not the 25% you had last year. If you look at the P/E ratio in the U.S., they are well above now historical average. If you do the Shiller cyclically adjusted correction, significantly above historical average, while paradoxically in Europe, they are well below historical average. So this year, actually, you could see Eurozone stocks outperform actually those in the United States because P/E ratio valuation are much lower than the United States. So even if growth is lower than the Eurozone, they're coming from recession, tail risk are reduced, money is flowing into the Eurozone, European stock market could be better than the United States this year.